runway ahead, because what we think is not well understood is exponential growth. I think if we step back and look at Amazon in the early 2000s, I remember buying that stock, and many people derided that decision because the thought process back then is in the tech and telecom bust, which is, the internet is a figment of Wall Street's imagination. What makes you think Amazon's ever going to make any money? And if you did at that time assume that Amazon's revenue growth would compound at a 20 to 30% rate for the next 20 years, you would have bought that stock all day long, even if you were using a dividend discount model, right? I feel like our portfolios are filled with Amazons because the seeds for what we are doing now, they were planted in the tech and telecom bubble, and they have been gestating all this time, and now they're breaking out to those growth trends, just like Amazon did.
So the portfolio may not be able to replicate the 500+% gain it's had in the past 5 years, but it should be, based on what you just told me, well over 100%. It should double plus in the next 5 years.
Yes, we expect more than a doubling in our portfolios over the next 5 years.
If I look backward, as you well know, Tesla accounts for almost a fifth of the return that you have generated in that 5-year time span. Which of your current holdings, Cathie, do you think will supply the biggest lift in the next 5 years?
Tesla's still in the running, but I would have to say the biggest upside surprises are going to come from the genomic space. And that's because the convergence of DNA sequencing, artificial intelligence, and gene therapies, importantly CRISPR gene editing, are going to cure disease. That convergence is going to cure disease. Now we have real science and technology surfacing the mutations in our genomic profile. And as they surface those mutations, what do we see? We see the earliest manifestations of disease. And now, with the combination of artificial intelligence and gene editing, we're able to both anticipate diseases and cure them potentially. Beta thalassemia, we're seeing it, sickle cell disease. We even think it will work in diabetes, which is where most, if you look at the largest category of spending year to year in healthcare, it's diabetes.
Cathie, another surprise for me in your portfolio attribution is that almost none of your performance, just 20 points out of 600 points, is from Apple, Microsoft, Amazon, and Facebook, the 4 biggest contributors to the S&P 500 over the same period. What about them doesn't make the grade for Cathie Wood and for ARK?
Well, we're not saying they'll be bad stocks at all. In fact, they've been very good stocks. And they were a part of our portfolios in the early days. But as they were scaling into the $1 trillion category, we believed that our research would be focused better on the next set of fangs. And I don't mean fangs meaning in the internet age. We actually think the next fangs are in the genomic age. And if you'll notice our flagship portfolio, the largest exposure is healthcare for that reason.
What would make you reconsider investing in those stocks?
What would encourage us to move back into that ilk of stock is a continuation of what we're seeing now, so that some of our valuations become stretched beyond our minimum hurdle rate of return. So our minimum hurdle rate of return for any stock entering our portfolio is 15% at a compound annual rate over the next 5 years. So that's the doubling over 5 years. We're not there yet, but if we're in the low 20s, which is much more than a doubling over 5 years, but if we started seeing more and more of our stocks lose that return expectation and drop below 15%, we would move back towards some of the FANGs and Microsoft because we would be treating them essentially as cash-like instruments for our strategy. So what we do is, as a bull market extends, we do move into more cash-like equities. They would be the less volatile stocks, and certainly the FANGs and Microsoft fit that. And we would do that increasingly.
ETFs are by definition public market vehicles. I've wondered this as well. Why not extend your investment thesis to private markets and raise money to invest in venture capital and in growth equity, because so many of the things that you're interested in get their start there?
Absolutely. Well, one of the reasons was the low-hanging fruit in the public equity markets. Innovation had been neglected in the public markets. It had become overvalued in the private markets. My stomping ground was the public market, so it made sense for me to start there. Now that the valuation discrepancies are narrowing to some extent, not completely, and because we must know private companies. And in fact, part of our research ecosystem with the social networks, getting involved with companies as they're innovating. A lot of them are private, and we're talking to them regularly in on social media platforms. So yes, we are evolving some strategies. We hope that next year we'll be able to launch something. What I would love, and it would be true to our stripes, our current stripes, I would love, because I know the SEC is opening up to this, I would love to be able to offer a public-private option that would be available for all retail investors. Right now, we have to, the private world has to deal with accredited investors. So there's a screen. I believe that screen is going to start coming down over time. And I'd love us to move into a world where we could offer what we do across both public and private companies.
In the form of an ETF?
I don't think it can be done.
No,
in
probably not.
ETF, just because of the way market makers and authorized.
Sure, the creation redemption mechanism.
It would be very difficult, but I'm sure that we could find some other wrapper, maybe a separately managed account wrapper, in which to make this happen.
Right now, Cathie, your ETFs alone are generating an annualized run rate of $220 million in revenue, and that doesn't include the other assets under management. How profitable is the business?
Well, our business is very profitable now, but believe me, the blood, sweat, and tears that we left in the early days, it's a scalable model. So we had to pay for the infrastructure in the early days, and we were quite the loss-making company. And I felt it acutely since I funded most of it for the first 3 years. But in those early days, we were investing aggressively, which is what we tell our companies to do, because we thought we would be able to scale. And when we were able to scale, we'd have the right talent in place to scale. And so we've done that. And I'm very happy to say that we are able to reward those who are making us happen, the team that's making this happen, and rightfully so. So in a way, the hedge fund model, you have maybe fewer people and less in the way of assets, and the same kind of profits. So we've done it a different way, and now we've shown it's possible, and we think it's a really healthy way to go as well.
Cathie, in the midst of the incredible year ARK is having, you're in a legal battle for control of your firm. How on earth did that happen?
Well, I will say that has quieted down, and we are in negotiations. I think all we wanted were negotiations, and we wanted to be fair and square with our partner. And I think things will work out. I think we're well on our way.
from your perspective, does working things out leave control of the firm either in your hands or the hands of you and your partners, your colleagues at ARC?
Yes, it does.
And if things were to go pear-shaped, and for your sake, I hope they don't, do you have a nuclear option? Could you just take the team, pack up, walk out, start a new firm, and create new ETFs?
I could not. I could not.
You have a non-compete.
And a contractual obligation.
Okay.
Yeah.
So both sides then have an interest in coming to the table.
Yes.
Cathie, ARC manages 5 active ETFs, all of which have more than $1 billion in assets. Are there any others that you have wanted to create, thought of creating, or in the process of creating?
Yes, and we, one of our partners, a distribution partner in Asia Pac, Nikko Asset Management, the Japanese market is a very interesting market. The clients, the investors, basically tell the distributors what they would like to see, and we've learned from them. So our fintech portfolio came out of Japan. It started in Japan in 2016 and in the US in 2019. They have a space exploration fund. We're looking at that one at some point in the next year or so, hopefully. And also an SDG fund we are likely to launch there, and SDG Sustainable Development Goals, the UN 17 goals. Our technologies, our 17 technologies map, or I should say 5 platforms and 14 technologies, so that'd be 19, map beautifully against those 17 goals. So it's a natural.
Historically was a huge contributor to your returns. And I know you're still bullish on it because ARC recently published 2 very favorable white papers on Bitcoin. But so far as I can tell, there has been no Bitcoin in the ARC Innovation ETF for more than a year and a half. How come?
Yes, well, we put it in at a 1% position in 2015 when Bitcoin was $250. And we scaled with it. We didn't sell it at all. So it hit 10% of the portfolio, at which point we were forced to sell. And at the same time, there was some forking taking place. So we were getting distributions. And what we learned is that Bitcoin threw off what's called unqualified income, which is not illegal, but from an IRS point of view, if our portfolios generate more than 10% of gross profits in unqualified income, which is usually commodity-like income, the IRS allows that 10% and then will confiscate the rest of it. So if we moved into a black swan event where the equity markets imploded and Bitcoin took off, our clients would be able to keep only 10% of that gain. And we just thought this was too much of a risk from a fiduciary point of view to subject our investors to. So what we did is we moved out of it in early 18, better lucky than smart, because of course we went from $20,000 down to, at the end of 17, down to below 4,000 earlier this year. In our fully discretionary portfolios, where we are not subjected to the 40 Act rules of the SEC, our Bitcoin position is about 7% right now. So that is how optimistic we are on it.
And it's once again flirting with $20,000. Can you put a price on your level of bullishness?
We are extremely bullish. Our confidence in it has gone up since 2017, because what we saw as it dropped from 20,000 to below 4,000, it actually got well into the threes, I think in 2019, was that Bitcoin's share of the crypto asset ecosystem moved from the low 30% range in terms of value, network values, into the low 70% range. And what did that tell us? That confirmed in our mind that Bitcoin is the reserve currency of the crypto asset ecosystem. So it is the reserve cryptocurrency, which is a very important role. It's the flight to safety currency. It is Bitcoin's technology or Bitcoin's blockchain is the most secure of any other blockchain. And so it makes sense that Bitcoin would be the reserve currency of the crypto asset ecosystem. I always say, try and figure out a way to measure your success in a way that, no one can take it away from you. And that does not mean not being a team player. Being a part of a team that develops a great track record is really important. So many people say, wow, your industry seems to be quite lacking when it comes to women in portfolio management positions. And that is true. And I do think it's an unfortunate case of last in, first out in two periods, tech and telecom bust, 08, 09. And so that's unfortunate, but I have the highest regard for the industry. It is a heck of a lot of fun. It's extremely challenging. The world is our oyster, as long as you're not playing the old game, which is benchmark sensitivity, as long as you really are investing in the future. I think allocating capital to its highest and best use in terms of what we described earlier, increasing access, solving the world's problems. There can't be anything more satisfying from a career point of view.
With that being said, I hope you guys enjoyed this video and you did find some value. If you did, please do big thumbs up and comment your thoughts below. And if you're new around here and you still haven't subscribed yet, what are you waiting for? Go ahead and hit that subscribe button and turn that notification bell on. But with that being said, I hope you guys enjoyed this video and you did find some value, and I'll see you guys in my next video. Invest safe.